It's September 14th, and this is of course the video log. It takes 30,000 to a million, and I have to make another video about this. All right, I'm gonna be bashing and trashing leveraged ETFs once again. It seems like one of the most popular videos ever made for some reason is my warning for the triple X and double X leverage ETFs and how I usually advise people to steer away from it. Now, normally, there's the disclaimer that, this isn't financial advice and it's for your informational purposes and entertainment, whatever. But this is one thing that I strongly hold and try to steer people away from, especially people who are just starting out, right? If you're an experienced investor and you're very financially literate, maybe you worked at a firm or something like that and you know the ins and outs, you're a very technical person and you understand exactly how these leveraged ETFs work, and then maybe this video isn't for you, right? But if you're just an average investor using Robinhood and you haven't actually read into the prospectus of these leveraged ETFs and how they work and how leverage affects them, how time affects them, you don't know about the beta decay or the volatility drag or whatever kind of term that people are inventing for these effects, then maybe you should either listen up and I'm just going to show you some charts and some stuff about these leverage ETFs, or you can just go ahead and read up. There's plenty of articles about them and they explain the math about them, but I just keep getting comments on my video about it, and people are just trying to argue at me about how they have, if you did this in this leverage ETF, you've had so many and so many returns. So we're going to look at some graphs and we're going to see how that's happening. But first, let me take you through the account. I am sitting now at $120,487, so a little bit of an update today. Today's the Monday. So we'll see tomorrow. It's probably going to be a little bit of reversal Tuesdays, whatever. And so I'm going to quickly go through the account. I really don't feel like spending much time on the account because I got a lot to show you. So I'm just going to go through the options here that I have running, and then I'll show you the rest of the positions. If you just look at the symbol here, this is the ticker of the position, the strike price, whether it's call or put, the expiration date, number of contracts, and then whether it's a sell or a buy. And that'll give you all the information you need from all these positions. You can see how they've traveled today, the change in liability today on the right side here, and then the rest of the data on the left. Okay, and these are my stock positions here, my holdings. You can see the Apple, and then I'm just gonna quickly scroll through it. You can pause the video at any moment and see exactly what I'm holding if you're so interested. And these are some things that I'm watching. This is what I'm watching right here. It's my watch list. Okay, if you're interested, these are the kind of things that I'm following and I'm keeping my eye on it. Okay, so some of these suggestions by viewers actually, like Rolls-Royce, for example. This is the account tab. Oops, that is not the account tab. Misclick. Honest mistake. Account tab if you're interested. This is kind of like a really good infographic to tell you about the account, sorted by total return. And then, by the way, I have a lot of options expiring on Cameco, and so I'll be selling those. I'll be forced selling some of those positions. So Cameco might drop from being the second biggest holding to like third or fourth pretty soon. And this is sorting by equity. Luckily, my 4 biggest positions are winning ones so far as asset appreciation is concerned. All right, that's enough about my account. Okay, I want to talk about these leveraged ETFs. So I had some nice comments and I had some really brutal comments. Some people calling me an idiot or something because they didn't straight up say it, but they were saying how my logic is flawed and this and that because I'm bashing on these leveraged ETFs and how plenty of people could have made a lot of money by holding onto a leveraged ETF over many years. And so they're linking me articles and things like that. And one article that got linked to me really recently is this one here. All right, let's see how much view you can see. Yeah. So, I mean, I read through this article and if I remember, I'll leave the link below in the comments. I mean, in the description of the video so you can read it for yourself. But there's very little out here that I found that is misleading, you know. Plus, it doesn't really matter. Like, all this math here that's been done is very descriptive, but it doesn't matter to the overall effect. Like, you can describe the effect, you can mathematically like derive the expectation returns, you know, some of the examples here, and you know, funny enough, all of these are U.S. markets besides like one or two of them. The ones that are not U.S. Markets are down here and they don't look too hot. Like, for example, the Japan one. But obviously Japan's been in a slump since the 1980s. So that's an outlier here. But you can see for example, the FTSE 100, which is a very, very developed market, leverage of 1 and 2 is the same. But it's I mean, look, the dude's done some homework. I did find one kind of error here when it comes to the logic of it, and that error was that you know, that when he starts to talk about leverage of 1, I know leverage, okay, versus leverage of 1.1 or 2, and why is that safer and that's not safer? Well, the thing about, you know, when you're talking about leverage of 1, it doesn't really suffer these, like the SPY, for example. Okay, it doesn't really suffer beta decay much, or volatility drag, whatever you call it, because it just replicates the daily movement of the price, right? So if stock, you know, if the ETF goes from 10 to 11 the next day, if the SPY, or the S&P 500 goes from 10 to 11, the SPY, right, the ETF is also going to go more or less to 11. So there isn't much much difference there. So it's going to exactly copy, and then on the down move, if it goes again by 10%, is going to go to about the same exact price. But if you add a leverage of 1.1 or 1.2 or 2 or 3, then the difference between the two swings is going to be big. Now the prices all of a sudden become disconnected. Okay, so because the prices are disconnected, right, they follow their own trajectories now, and they're not going to be identical, whereas a 1-to-1 correlation is always going to be identical, right? All right, so but that's not even the point that I'm trying to make. Let me show you some stuff, okay? So what's happened here is everybody's looking at these, and one thing they're missing out is that the SSO, which is the double X SPY for the year, is actually down 1%, while the SPY is actually up 5% for the year. So the 2X has failed year to date to score a new high like the SPY. But let's take a look, and that's because the year has been leveraged. The year has been very volatile, right? We had that drop in March, so the volatility is really killing the underlying leverage ETF. And so the higher the volatility is, the more this effect is gonna take place, and the lower the returns are gonna be. But let's look at some outliers, right? So this is what people are linking me, okay? Like, all right, so here, for example, is the NASDAQ. Let me see if you can see it. This is kind of important, so I'm gonna actually modify this. I'm gonna unlock the, okay, let's see if we can do it. I'm gonna put a little bit more full screen so you can see the charts better. And I'll fix it later, because this is importante. I think that's good enough. Okay, so this is the NASDAQ, right? So NASDAQ has been on an upwards trend for a long time. This is since 2002 or something like that. But let's move on. 2009. It's great. I mean, it's returned 1,000%, whatever. I don't know how many hundreds of percents. But let's stack on the QQQ, which is a double leveraged NASDAQ, right? And then here we go. NASDAQ has moved up, let's say since 2009, because that's kind of when they intersect a little bit. Since 2009, the double leveraged ETF has moved up to 800% instead of the 481 for the regular NASDAQ index. So that's obviously beneficial over many, many years. That's, 10 years or something like that, 11, 12 years. So let's unlock the triple leveraged ETF, which is the TQQQ, right? Boom. All of a sudden, we went from 480 to 850, right? And look how big the difference is. I mean, it's huge. Okay, this is almost 7,000%. And if we zoom out, I think maybe it goes further. Well, no, because it was created kind of late. Anyway, so 7,000% up if you bought the TQQQ in the beginning when it was first created. So that's great. People look at this and they're like, okay, well, double leverage is better than single leverage, and triple leverage is better than double leverage, duh. But even the article guy admits that at leverage 4, like basically nothing works long term, including the NASDAQ. But it would work if there was a market index like the NASDAQ that was high enough of a gain per year with little enough volatility. All right, so if everything goes up every day by a little or by a lot, the more leverage, obviously, the better. If you had 1,000 leverage, then in 10 years, you'd be, a quadrillionaire or something. I don't even know what the highest Googleillionaire, whatever the highest number you can think of is. But my point is that this is actually an anomaly, right? The U.S. markets have been going up steadily over time in a very atypical manner. All right, so let's take a look at the S&P 500, which is another U.S. market. So here we go. This is the regular SPY, excuse me, S&P 500. SPY is the ETF that measures it. It is, on this chart, it's up almost 5%. And let's put the double leveraged ETF. All right, so on this chart, since the beginning of 2020, roughly, it's actually down 1.7. So the regular index is beating it. Of course, you can zoom out on this chart and you can see the correlation over a longer period of time. It's not bad. I mean, it's not as impressive as the NASDAQ, but it's actually, because the volatility is so low on the S&P compared to the NASDAQ, you can see the difference is actually quite a bit. So when we went back to 2009 with the NASDAQ, it was up like what? I don't know how many. I've already forget the figures, but the gain was roughly double for the 2x leverage ETF. But over here, it's not even double. It's like quadruple almost for the S&P. And the reason is because it's very steady grind, right? More companies, a steadier grind, less volatility to eat up the return. And you can actually quadruple the money. And let's see what the, I'm sorry, that's the triple. I messed that up. That's the triple ETF here. So, no, I got it right. Yeah, the SSO is the double, and then SPXL is the triple. And then let's look at the triple one. And that one didn't return 1,000, it returned 1,742. So the results are kind of getting tapered off a little bit. But you can see how one drop here in March, this recent drop, right? That's another downside to these leverage ETFs. If you mistime it, like, it's really bad news, right? So you've been taking all this risk, let's say, since the beginning of time, the beginning of these ETFs, whenever they were created, okay, probably somewhere around here. And you've been taking all these risks and riding this wave all the way up. And now what happened in the bottom here in March? They all basically converged to 1 point. And had the decline resumed, right? Had the Federal Reserve, for example, not stepped in, and we had a few more down days, this index would have been wiped down to zero, basically, right? Or almost zero, like 1%. And then it would be nowhere near where the S&P SPY is right now. It would be losing to the SPY in a 10-year plus range. Okay, do you see how dangerous this is? I mean, we were on the verge here. If it didn't bottom right here, let me see if you can see it on the video. Yeah, you can. If we didn't bottom right here in March, this would have been really bad news for the SPY. Okay, so let's go to, so these are basically like the darlings, right? These are the two indexes, maybe even the Dow. I haven't looked at the Dow, but the U.S. markets are what people use as a benchmark to argue for the leverage ETFs as long-term investments. And I'm really against it. I mean, this is a very atypical scenario. If we look at any other ETF that's leveraged, virtually any other, then what we have is basically carnage. Okay, just extreme carnage. So we have, 2 or 3% of the ETFs that are related to the US market somewhat are doing fine of the leverage ETFs, but the rest of them are just getting decimated. I mean, it's a bloodbath. It's really, really bad, okay? Like they're a little bit more volatile, they've had some recent drops or whatever, and they're just getting murdered. And we're going to look at some of these darlings that people are trading and trying to, I mean, it's okay to trade if you know the risks and stuff, but don't invest long term into it. Like, look at what's going on here, all right? Let's check out US oil, okay? So this is US oil. Okay, down 61%, no big deal. Let's take a look a little bit long term since 2001, 2003. Okay, that's fine. But let's pull up the leverage version of it, which is Gush, which a lot of people are trading and trying to buy, okay? Look at this. And this is just since 2013, right? That's when the index was created. Well, actually 2015. When the index was created, look at what's the ETF, not the index. Look what's going on, right? Oil is down 21%, and then this thing is down 99.96%, basically 100%. It's gone. So even if oil rallies a bunch from here and goes way into positive territory, Gush is going to be still down here in the dumps. It's going to go from minus 99.96 to like minus 99.93 or 91 or something. All right, so it's just going to get eaten up. And so if you're trying to hold a commodity like oil long term and gain a little bit from the price, and this price hasn't changed that much, it's just down 21%. I'll show you some more shocking examples, okay? So look at this. Now that you see oil, how about we go to another commodity type minor index like the GDXJ, or even pull up the GDX. It's the same thing. All right, what's going on here? Too many pop-ups. They want me to sign up. Okay, so this is the GDX, right? Let's see. We had we're plus 73 something percent. All right, and since 2014. Plus 27%. I don't know. It doesn't matter what it is. Let's take a look at what it is. With the JNUG, which is it's triple X leveraged ETF. Minus 99.48. You might expect that since it's triple leverage, then it would be, instead of up 27%, it would be up like 90 or more, right? But no, because volatility just eats up. Look, I'll zoom out and zoom in to show you that I'm not really picking a time for this. I'm not picking like a timestamp, right? I'm just zooming in, zooming out. It's down. It just, the further out I go, the more it just gets destroyed versus the GDXJ. And you can find the same thing with GDX and its corresponding leveraged ETF. Look at this. It's horrible. Right? So JNUG, no go. Don't do it, right? Okay, fine, but these are just commodities and miners, right? So oil is a commodity, or junior miners for gold, very risky and volatile. How about we try something that's just non-American, right? Something outside of the US, another index of another major economy around the world that's perhaps been growing over the last 20, 30 years. And it's similar boat as the United States, but it's not the United States, okay? How about China? A lot of growth is the big story of the end of last century and the beginning of this century. Huge growth, right? You'd think, it's relatively flat markets here would be a good way to, slap a leverage ETF on and see what happens, right? So it's returned since 2011. It looks like in the last 10 years, returned 3.8%. We slap the leverage ETF, we should get, I don't know, 8% positive, at least, maybe more. Let's see. Nope. Minus 56%, minus 55.89. Right? Not a very good long-term investment. There's been periods on spikes where, look, over here, it went up 75% on a spike here. It was up 42% on a spike here. But this spike is it's taken a while to recover here. So we're looking at a huge loss. So let's say you had a 10-year horizon, and instead of investing in China, you decide to lever your bet. What are you left with? You lost half your money instead of holding on to it and maybe even gaining 4%. So that's China. What about something that's, like let's say US plus Europe, right? Let's add Europe in the mix because those are developed markets, right? Or whatever VEA holds. How about we look at VEA? It's not like China. It hasn't been flat. It actually went up 63% in that same time frame, in a little bit over 10 years here. So if we slap on the leveraged version of it, then theoretically, right, since it's up a lot, 63, then we should be up a lot more than that, right? Like, I don't know, 120 more, 200% up. What do we get? Negative 60. We get negative 60% right now. Okay, markets that are all-time high in the US, developed markets overall, minus 60%. Okay, by holding a leverage ETF for this long. There's been periods where it's popped up. Look, 200% here, 229% here on January 2018. But look, now we're down 60. And our time frame is coming out. We got to pull out. We got to buy a house. We got to pay for retirement, whatever. Boom. You're down 60%. Developing markets. Even though they're up 82% over the last 10 years. You see how it eats away? Like, this is the point I'm trying to make, is I don't really care how much math you put in front of me, right? I'm not against math. I like math. But you don't need to understand the math to believe your own eyes. So this is the effect, right? You get up 80% on the regular index. You're down 60% on the leveraged ETF over a 10-year period. This is reality, right? So if you're going to go and bury your head in math, just look up and look at reality first, and that should tell you that there's something wrong with your calculations, right? So just because the NASDAQ and the S&P and some of the US ETFs have happened to go up steadily with little to no volatility over the last decade or two or three, it doesn't mean that that's normal, okay? These are outliers. The volatility is low, the gains are huge, and if you want to, bet on that, that's fine. That's going to continue, that's okay. Do it. Just know that there's huge risks ahead. One big crash could wipe out your entire holdings. You could be putting all your savings in there, make $100,000 over 10, 20 years, however many it takes you to save up that much money, and it could all be gone in one crash, and it won't recover. All right, if it goes down far enough, it won't recover. Like, we were just a few negative days away in March for the S&P one, SPXL or whatever it was, to be unrecoverable territory, just like the oil one or the GDXJ, right? It's dangerous, okay? So you can see virtually any other ETF that's leveraged, other than the ones that are tied to roughly US stocks, like especially tech stocks. It is a bloodbath. It's carnage. So you're talking about 1 or 2%, or maybe 3%. I don't know exact number, but it's a very top few percent of the leveraged ETFs that make money over the long term, and that's also very risky because it could get wiped out in a few weeks. All right. So this is my warning to y'all. Okay, just don't. If you are an advanced investor or trader and you want to risk that money and you understand exactly what's happening, this video is not for you. Okay, it's just not. But if you are not an expert, all right? If you haven't read the ins and outs, if you haven't touched every detail, understand exactly what's happening, and looked at graphs like these, then don't do it, okay? Find an investment that you're not going to lose all of your capital from, all right? That's my advice. So this is my warning number 2, okay? So hopefully this like puts all the doubters at rest. All right, that's it. I'm tired, okay? Speak to y'all soon and probably make another video on Thursday. Peace out.